Great. So good morning, everyone, and welcome to day 3 of Fraud and Risk Analytics on our session 3 today. So in our first two classes or sessions, we talked about fraud, different types of fraud, more focusing on, credit cards as well as frauds in general. Today, we do the other part of the topic, which is on which is on risk and different types of risks and how do organizations become more prudent in terms of handling or analyzing these risks, which obviously have a harmful effect on the organization itself, the image as well as the profitability. Many or risk as a function used to report into finance earlier through the CFO. And now I think in many cases, especially in the banking industry, you have a requirement from the regulator that risks should not report into finance. It should have a independent reporting and not also to the CEO, but to the board. So the chief risk officer or an equivalent position came in, and this position does not report to the CEO. They have a dotted line reporting, but the direct reporting is to the board. So you have a risk committee operating at two levels, one at the board level through the corporate governance structure, and the other is at the day-to-day level. So, but it is both managed by the CRO or the chief risk officer. Similarly, another function which has been given more, weightage or importance or empowerment to do independent work, and that is the audit function. In the past, the audit function was reporting into the CEO, but not anymore. The audit, like the risk function, reports to the board, and they have a dotted line reporting to the CEO. For example, compliance with the regulation, compliance with making sure that the bank goes through a lot of prudent checks and balances on its processes and procedures, is all driven by the chief risk officer in conjunction with the chief audit officer. So this function has grown in the last few years, and risk, therefore, has become an important aspect. You have somebody within the risk department also to dedicatedly look after a regulator reporting. If it's in the telecom world, you have the regulator there as well. If it's the banking, it's the central bank. So there's a lot of reporting that goes to these regulators on a monthly basis, and you need a dedicated resource to be able to do so, because not everybody is able to get access to the central bank servers for you to go update or transport or transfer the data that is yours to this regulatory portal on a monthly basis. Yep. So having said that, let's try and understand this function of risk analysis, which is very, very important. And this is picking up its importance a lot, especially in the last few years. So, for financial institutions, things are different compared to our individual balance sheets or our or the way we look at finances. An asset for us is a liability for them, and a liability for them is an asset for us. So when the bank says asset products, what are the products that they are referring to? They're referring to basically the interests that they get from us on the loans that they have disbursed for us. So all credit cards, all kinds of home loans, all interest income, all fees income that they get are all a part of their asset products, because that is something that helps them earn incomes at their through their balance sheets. The biggest cost element for them for these different kinds of loans or credit cards and fees is basically the loss that they would make if a person does not pay their loan on time, does not pay the interest on time, and therefore that becomes a cause of concern. Now, when banks want to talk about cross-selling or upselling, what are they talking about? They are talking about those people, for example, who've taken a loan, must take their credit card, and therefore that is upselling for them. If they have a credit card and they have a basic credit card, you upsell, you cross sell to them the other kinds of credit cards that you have so that they can now become a platinum member from being a silver or a basic member. Okay. So those are the kinds of things that they work with when a bank says, uh, these are my asset products, what they're referring to is basically loans and credit cards. The other side of their balance sheet, which is liability, and that is their current and savings account, which is called as CASA, current and savings account, or rather current account and savings account. And this is something that is their liability, because if you close your savings account at any point of time, you have to pay off the interest that you earn on the deposits. Current savings, fixed, all of these are therefore a part of their liability products. So asset as well as liability. What are the risks that these institutions face? And therefore, we need to be mindful and classify risks accordingly. So we have credit risk, we have fraud risk, we have operational risks, and we have market risks. What do we mean by credit risk? Now, credit risk is an important function with banks because they lend out money to individuals as well as to institutions. What if they default? What if they don't pay their monies on time, including interest on credit cards? While they want you to not pay your entire amount on time, and they will charge you an interest on the balance amount called as finance charges. But a lot of people eventually will pay it out through a 1 or a 2 month period. But some people who do not pay and who continuously default on the interest and therefore the principal poses a risk to the bank, and that is a credit risk. It obviously has a direct impact on the balance sheet because if you don't recover money, you pay money to recovery agents. That is a cost, and therefore it eats into your profits, and your profits kind of shrink because of credit losses that the bank might incur. You then have a fraud risk, which we've talked about, different types of frauds, intentional, unintentional, insider trading, also something called as money laundering. All those types of frauds is what we spoke about. Operational risk emerges from the operations of the bank. And in this occurs, say, for example, there is a cyber threat attack on the IT servers, and therefore that's an IT operation risk. Operations team poses a risk also because if there is no maker checker system with regards to the postings made and the balances calculated, this leads to an operations risk. And then last and final is the market risk. What better examples than, for instance, the pandemic, and this posed a risk. And now people are weary about the fact that interest rates have increased a lot in the last 6 months. Fed has also increased it from the US. Economies globally are facing this threat of inflation. And we expect another inflation to kind of come sooner. It was expected to come in end of this year. It's now expected to come into the market, come into the world and spoil the ecosystem in the next quarter of next year. So first quarter of next year is when the US and various central bank experts are saying that it's going to hit it. So this is obviously a market risk, and it poses a risk to the organization as well. So credit risk, fraud risk, operation risk, and market risk. Who do you think the credit risk function or this credit risk aspects is which responsibility in a bank? Whose responsibility is to ensure credit risks are maintained? It is the chief risk officer, with some parts of it also given to people who look after the credit function, and they also have it, but it is the prime responsibility of the chief risk officer or the risk function. Yes, Simanti, we need to be very careful. But again, as I would just take that statement a little bit forward, and I say we know that Okay, so if we are careful, uh, at the cost of what? A lot of organizations believe in the philosophy that if you don't take the risks, you don't get the returns. So yes, there has to be a proper balance between risk and returns, so that you cannot be a 0% credit risk free organization, but it is at its minimal. So credit risk is the prime function responsibility of the chief risk officer, with some coordination required from the credit head also. Fraud risk, again, is primarily the responsibility of the chief risk officer. Operational risk is the responsibility of not the chief risk officer, but the chief IT officer, CIO, COO, chief operations officer, and CHRO as well, because there are a lot of people risks involved when you recruit people and when there is external people coming into the organization, either as consultants or as freelancers. So credit risk, fraud risk, operational risk. Market risk, again, is a function or a risk function that is under the direct purview of the CRO, the Chief Risk Officer. So as you can see, the risk function is getting bigger and bigger over the years because the kind of risks have also gone up. Now, when we say the Chief Risk Officer, in the risk department, there are further verticals that are being put together, and one vertical will always look at credit risks, one fraud risks, and one market risk. So these functions are further segregated within the risk function. So the risk function, which used to not exist independently earlier, has started to exist independently. And on an average, a medium-sized organization will have about 3 to 5 people in this department, with a large organization having about 7 to even 10 people in this department, looking after the risks and the frauds that emerge out of it, to protect the organization from avoiding or minimizing it. So the biggest function, or the largest contributor in the to the risk function, is the credit risk, because that is a day-to-day function. You give money on a day-to-day basis to the people concerned after doing due diligence, and you want to make sure that this credit risk is at its minimum. Okay, now here, Sumanti, your question, and the answer to that question is, one of the CRO's jobs is to make sure that there is a very good balance between risk and returns. We know we cannot eliminate risk. It can never be zero. We know that. Why? Because if it is zero, then probably there is no business. And if there is no business, there is no profit. Okay. Some risks are needed. And as some organizations say, if we don't take the risk, we don't get the bottom line. And therefore, they are taking above average risks to get an above average income. Now, that has to be balanced very well as well. Don't provide to very risky, but slightly risky segments or groups or countries of people that you are dealing with. However, when don't let they say, don't put all your eggs in one basket. Very true. Don't, in the event of getting profits, do not overburden risks to such an extent that a large chunk of your income is from risky business. Okay, a minimal is okay, about 10 to even 20%. But anything above that is a cause of worry for the organization that you're looking at. Now, some organizations are on the contrary. The risks are never more than 5%. So they don't make much profits, but they are always prudent about the way they make profit, number one. Number two, they hardly have any risk casualties that they have to work with. But on the other hand, their income is much less because their businesses are not as risky as their competitors are. So you need to make sure that there is a good balance, as in you, in the sense, the organization needs to make sure that there is a very good balance between risk and returns. And therefore, prudent risk management is an important function for organizations. Now, here is a case study, guys. Please take a picture shot of this. There are two cases in this, the Bank of Baroda case, and one is in the Mumbai branch. This is this part of the story. And one is in the New Delhi branch, and that's this part of the story. So there are two frauds, rather two risk-related frauds that have happened at Bank of Baroda in the New Delhi and as well as in their Mumbai branches. So the key problem that has happened is in the New Delhi branch, they had a money laundering of 6,000 plus crores. And in their Bank Ahmedabad branch, they had it to the tune of 350 crores. Okay. Money laundering, we are aware of money laundering. Let's try and understand the concept of bill discounting before we begin to address this case. So what is bill discounting? Also called as letter of guarantee or letters of credit given to the buyer, between the buyer and the seller, but given by the bank. So how does this usually work? You have obviously the seller selling goods to the buyer, and that is this part one. When the seller is selling the goods to the buyer, they also draw a bill on the buyer as an invoice saying this is what you got to pay. The buyer signs off saying yes, we accept to pay, and that is then presented by the seller to the bank. The bank will credit the amount to the seller. So the bank acts as a letter of guarantee, or the bank acts as a guarantor on behalf of the buyer and meets the requirement to the seller. When the goods are delivered, the payment is made by the buyer to the bank. Okay. So this is how the bill discounting process works in a bank. Okay. Now, for that bank study or for that case study, these are the kinds of questions that we want to answer in our discussion. Types of risks that are faced by the bank of the ones that we've studied. What could have been done to prevent these frauds? What could have been the components of a risk management system if you were to install one? And would machine learning help in such a scenario? Okay, so these are the questions that will kind of structure your discussion. So take a picture of this. And obviously, once again, take a picture of this if you haven't taken it as yet. Okay, so Bankobar, I assume you've taken it. Okay, so we'll give you about 15 minutes again in your breakout rooms to discuss this, and then we come back and discuss it as a class. So we have, how many of us are there today? 18 of us. So let's try and do this. We'll do 4 rooms today. Yeah, 4 rooms today. All right. Good. So about 15 minutes, and then let's come back and discuss it as a class. You people are done, right?
Yeah, Professor.
Okay, yeah. The others are still doing so. Another couple of minutes, and then we'll come back to the main room. Yeah. All right, great. So, any starters? One, two, three, or four? Any of the four rooms who want to go for? Who wants to go first? First, Travis.
So I can go where we're in group 3. This is Amit.
Oh, okay. Yes, Amit, go for.
So, so if you don't mind, please bringing up the questions. But I've noted down. So I think for the first one, it was what kind of risks are being faced by the bank, right?
Right.
So I think one was there was really no risk profiling of the new customers. Like it said that at the certain Ashok Vihar branch, certain new accounts had been added. It seems like there was no risk profiling or KYC done appropriately for them to verify their authenticity or if they're actual customers. The second risk was there was no really monitoring system in place for these transactions to flag them as inappropriate. Right. So we saw there was a huge jump, a surge in transactions, but there was really no system in place at the bank to trigger any alerts for that. So those were the risks that we saw.
Sorry, Amit, of the four risks that we talked about earlier today, credit, fraud, operational, or market, which ones of these are evident in the case?
So I'm sorry, I joined really late. I joined 15 minutes late, so I didn't cover that part of the lecture.
Okay. What
whatever.
about the others in
Hi,
your group?
Professor.
Yes.
It's Kaushik from the group 3 only. So I'd like to
Okay.
add that it will be, as per our understanding, it will be kind of operational risk as per our understanding, since they have not maintained proper um, KYC and proper tracking, then we would like to segregate under the operational fraud.
Okay. So Kaushik, if it's
Uh,
operational, under which head would you put them? IT, HR, operations, where would that go?
IT and operations.
IT and operations. Okay.
Uh,
Fine.
Hi, it's Dinesh here
Yes.
from Group 2. So for first
Same
case,
same room, my friend, or different room?
room 2.
Different room, yeah? Or
Yeah,
same
different
room?
room.
Okay, just hold
Different
on,
room.
Dinesh. Let's finish
Okay.
off with these guys and then you can come in, yeah?
Okay,
So
3 and 4.
Amit, anything else you want to add from your group? Kaushik has talked about the different types of risks. You've talked about the issues. Anything else?
No, sir, nothing for the first question. For
Okay.
should I move on to the next, or we'll go through?
Yeah, just hold on then. So basically, we are talking about the first question, which is what are the types of risks that were faced by the bank, and then also cover this part. What could have been done to prevent the frauds? And I think that's what you just mentioned, that there was no proper check, there was no proper system, right?
Right.
Okay. So basically, we've covered the answer so far from your group for 1 and 2.
Yes. Yes, sir.
All right, good. Yes, Ganesh, you can go now.
Yeah. So
But
there were 2
we'll
cases.
talk about the first 2 questions only right now, yeah?
Right. Yeah. Yeah. So there were 2 cases that were provided in the case. So first one was regarding credit fraud. To be very frank, because ultimately bank had to pay in the month of September, right? So that was credit fraud, and the second was seems like more of operational fraud because there were a lot of transactions happening. New accounts open for forex. So yeah, those are the 2.
So when
items
you
that
say
we-
operations, which specific function within the organization?
Uh,
Like the other guy said, it's IT and ops.
yeah, here it will be ops, I think.
Operations, okay.
Yeah, operations.
Mm-hmm. All right. And the second part of this question, what could have been done to prevent these frauds?
Yeah, so I think one point was already covered regarding when the new accounts were opened, the proper verification or risk profiling should have been done for those, because again, it can be a case of money laundering where a lot of accounts were opened to dump that money through some other accounts. So that was one point. And for the discount one, we also discussed about some preventive actions like adding some machine learning algorithm based on which we can get some red flags that okay maybe on particular day there's a sudden spike in number of transaction or the number of amounts deposited or withdrawn from the bank. So that there should have been some flags raised, and then maybe as another action item could have been there could have been some audits. Say for example, maybe the new accounts got opened and there was some transaction happened, and there could be some audits happening on a regular basis which can identify such things. So yeah, those are
Okay, good. Yeah.
Just
The
a
other,
point. Just a
yes.
point.
Same
Check
room,
again.
Bharani?
Yeah, yes. Same group.
Okay.
So just a thought. Like again, there should be a dashboard, like a digital dashboard, which keeps on accumulating and showing the amount of transactions done and the number of transactions done per day, like a summary. That should be there in the that should be set up like for a real time monitoring. And that will make you be cautious and aware, which could have been done, like in addition to the machine learning algorithms.
Okay, good. Yes,
Question
the
to that
other.
again.
Yeah.
Sorry. So this is
Yes.
Kajal, same room.
Okay.
I just wanted to add on Bernie's point that we can have a dashboard displaying money laundering or such kind of cases score, where there'll be, if the score goes high, then a flag is raised. So that kind of score can be displayed in the dashboard.
Okay, good. The other 2 rooms, let's take the lead. If you want to say anything on 1 and 2, definitely tell, but take the lead on 3 and 4 question now, yeah? The other 2 rooms.
So this is Shimonti from room number 4.
Okay.
So adding on to whatever was covered for the first 2, points, but there was some ignorance also because when the forex transactions was spiked. Nobody had, gone back and checked as to what could have been the reason for the spike. So
Okay.
I think that on the prevention of frauds, we should have been more alert because reports do come in on these large transactions. So that was, I think, perhaps that was ignored. So on the covering on the 3 and 4 points, what could have been done for this? We could have had a make a checker concepts though we have in banks, but I think somewhere it was not followed. Maybe that's the reason this fraud was there.
Definitely appears that it's not followed, even if it's there, or if it's there, it's a very weak one.
Yeah, so reports reports which were triggered should have been people would have been more cautious in terms of the branch heads and the operations team, and there should have been a robust system of risk management process wherein yes we could have developed something where there could the triggers could have been addressed in a much better way.
Okay. Now, a little bit elaboration of risk management system. How would you propose that, what the components would be of the risk management system?
Somewhere when dashboards were discussed, yes, we can have dashboards on scoring mechanism as to if it goes beyond a scale of 7, 8, we should have a red alert flag. Obviously, the maker checker concept should be more robust here. They should follow that. Though I'm sure it is there in branches, but somewhere again ignorance was there, wherein we could have stopped this thing, and that's how I feel could have been done better.
Okay.
In terms of ML, how can ML help here? Obviously, with we can develop some algorithms, to attach an associated risk with this kind of transactions, so that it triggers us and the not only the branch, also the forex department. I think somewhere in the forex department we have different departments operating in banks. So forex department also should have raised an alarm when they see the spike in the transactions. So those kind of things could have been done using the machine algorithms. Also, we can train the models and attach an attributes so that it becomes easier for us to detect frauds.
Okay, fine, good. And the last room, whichever that room number was, I don't know, but the 4th room.
So, Professor, we were the 4th room.
Yeah. What I'm trying to say. So, therefore, whichever is the left room, yeah.
Sir, again, this is Amit from room 3. I think on the risk management piece, to be more specific, I think what we're looking for here is a system of internal controls that was really missing at the bank. And when you talk about components, right, any internal control system is essentially built up of 3 things, right? People, processes, and technology. And those have to work in tandem for this to work, right? And controls could be preventative or detective, in the sense that I think Simanti mentioned something about segregation of duties, right? So let's say someone's preparing a certain transaction and then there's an approval, and this is systematically enforced in the IT applications. Or there could be a detective kind of a control where, let's say on a weekly basis, a certain manager or someone high up in the bank has to review all the forex transactions and sign off on them. That way, certain ownership is established.
Very good. Yeah. Any thoughts, anyone, on branch controls being centralized or decentralized? Because currently it seems like there is a lot of decentralization in the branches, because there is a 2-branch scenario here. Any comments on that?
Decentralization is important, because then only we would be able to cater to the needs of that particular geography. But there has to be a central governing team monitoring that whether the policies which are implemented by the bank, are they being followed by the particular branches or not.
Okay.
So governance is very much required to remediate those particular risks.
Thank you for that word. And that's what I was looking for. And therefore, this case demonstrates a lot of gaps in the governance structures and systems, and therefore policies and procedures. Okay, good. Anything else anyone wants to add? There was one group, there is no mention. I don't know which is that group number. I don't remember, but anybody from that group? If 3 was said, 4 has talked about, 2 has talked about, what about 1, group 1 or room 1? Hello, room 1.
Hello, sir.
Yeah, room 1, Deepak?
Yes, sir, from the group,
okay.
room 1. So actually, maximum of the point has already been covered regarding the decentralization and also regarding the ML. And what we discussed was like it might be considered as a credit risk as well, because the money which is coming into the bank is from the unknown source. Like though the account was created, but it was not verified.
Great. A little bit on the light of, let's talk about the risk management framework itself. So do you think that there is a risk management committee that is operational in this bank based on what you've read?
No.
Because sorry?
Doesn't seem like, but
doesn't
even if
seem
it's
like.
there, yeah, they are not doing their job.
Even if it's there, it is a very weak system or structure. So the risk management governance is at its weakest to have these kind of problems. So, obviously, everybody having said, it looks like there are many problems here that you have to attack or address. In fact, everything seems to be a problem. Right? So how will you repair this? How will you attack to repair this thing? Bottom up, top down, everything across, lateral, vertical? How do you plan to come in as a consultant and repair this problem? So here, obviously, on the risks that were apparent, we saw there is a credit risk because it goes to the balance sheet. There is an operational risk, obviously, and this operations is across the board. It is in branch operations, it is in bank operations, it is in the IT systems as well. And there is a little bit of fraud risk also, because right now we don't know whether what is the role of the branch manager and the maker checker concept here for such a large piece or rather pieces of volumes of transactions going under the nose. So it seems to be a fraud risk as well. So those 3 risks are apparent. And now let's, what kind of a risk management framework would we want to put in? So how do we start addressing this problem? Yeah, should we go bottom up, as in, do we do roles and responsibilities of branch managers? Or do we start right on top and saying, hey, this is what the risk management committee structure should look like, and this is their charter? It's obviously the former or the latter.
So I think we should go top down.
Go top down, Amit, okay.
And establish, policies and procedures and a governance function first, and then have it roll down at the branch level.
Okay, very good. And when you establish that, along with that, I'll just add the piece, which is to build on policies and procedures also. If your policies are established, the procedures will be aligned to it. Everybody knows what they're supposed to do, and the due diligence needs to get done in a much more robust manner than what it is happening currently. Okay. So technology or automation should be used in terms of flagging red alerts. So your rule-based system should definitely be there, and these rules could be any transactions above a certain level volume, any transaction recurring within a certain period. So frequency, recurrence, amounts, all of these need to be coming in through the rule-based system to be flagged minimum once a day method. In the old time days, SBI days, they used to balance the branch balance sheets on a daily basis. And if you talk to an old SBI employee, they have fantastic calculation skills because they used to do the totals manually, not even with a calculator. So they used to fantastically do it, balance the branch, and then move out which is go home. But now, with so many branches on board, with so much of transactions happening across the branches, you have decentralization execution, but centralized controls. You cannot have branch decentralization controls as well, because that will create a disparity between how branch A operates and how branch B operates. And this centralization should be governed by the board of directors, the risk management committee, which should be chaired by the CEO along with the CRO person to be able to be a part of this risk management committee. Okay. So based on our discussions, I've put anything anyone wants to add, I've just put down some points here. Let's look at that. So guys, here what we see obviously is there is anti-money laundering. There is KYCs, which is weak, which is what was highlighted by you guys as well. And there is the framework itself is missing, as we as a class have agreed and discussed upon. So these are the issues that are stemming out of that needs attention and that needs some kind of controls to be taking place. A risk, and as we said, let's start top down, not bottom up. It's not going to help us. So if we start right at the top, it has to be to the risk management framework. And this risk management framework starts with the risk management committee, where you have the board of directors, where you have the CEO, where you have the audit committee also to get to do the audits, surprise audits and planned audits both. And this will help you put in a robust framework, which is going to help put in the policies and procedures that the bank has to work in place. Your KYC seems to be a little weak, in fact, a lot weak, and that needs to be built up. Anti-money laundering norms, which are established by the regulator, needs to be followed, and then needs to be reported to the regulator also. So your customer identification, onboarding, transaction monitoring, coordinating with the FIU, and regular employee training piece is also important. When you have new joiners, you need to train them on how to handle frauds, and not just one time, but it has to be a recurring training. At least some organizations mandate it by saying at least 2 trainings in 1 year to be given to every staff who is dealing with fraud and risk. Then this is face-to-face. In addition to that, there is an online training per quarter. So there are about 6 trainings which are mandated by organizations to make sure that the staff are prudent enough. There's a refresher course, they are aware of it, and they know consciously how to handle these frauds. Obviously, a big gap between the policy and the implementation, and a large number of factors has led to these implementation issues. Some of them are decentralization, and therefore the issue of how much power should be given in a decentralized setup, which is only execution, no policy framing. Policies governed through central offices. Bank officials are obviously not trained, and I think this aspect is also something that we need to look at when we are putting a fraud and risk framework together. The bank actually is more focused on sales rather than risks. So a prudent control check needs to be put in to balance the risk and the return or rewards framework. And as we had talked about, lack of internal controls for identifying the transactions, and this needs to be tightened and needs to be more robust than what definitely it is right now. And one of the key pointers of the internal control methods, which we have talked about as a class, and that is the maker-checker system, seems to be loosely organized, needs to be tightened up, and needs to deliver on results. Okay. Also, indicators of money laundering that were ignored. There were a lot of red flags that came in, and they were kind of overlooked at. Where you say, on the money laundering piece, on placements, layering, these are the things that are evident here, which is large amounts of money or accounts that were opened in a very short period of time. That is a red alert. Some of the accounts are not even verified because of the swiftness at which they were opened. Cash deposits received into the accounts and transfer of money immediately to other accounts with other banks. Okay, so outward remittances were also on the high. All of these, if have a robust system, can get detected earlier, so you can prevent the loss from occurring and prevent the fraud from occurring, and therefore disrupting the working system and also the profitability of the organization. So good, guys, that was well done by as a class, and I think we talked about it. And when you do it the first year, it's not good to say that it's good for life. It has to be reviewed every 2 years minimum, whether your risk management frameworks need to be revised, and what you will revise is the policy, so that the procedures get updated and upgraded as well. Yeah, good. Now we have some specific, because the earlier case did not cover marketplace frauds in detail, we have something to talk about marketplace frauds. And this one, if you can just read it or take it, this we will do it as a class, not in our breakout room. So if you do it, I just want us to know who's the fraudster here, who's the victim, and what is the medium and channel that is used here. When you're ready, just tell me, anyone. Yes, people, anyone? Who's the fraudster in this case? Who's the victim? And what's the medium and channel here that's used here?
Can I go ahead, Professor?
Yes, please go ahead.
Yeah. So I think the fraudsters are the people who are actually selling goods on the marketplace. And also the victims are the people who are buying it.
So where is Amazon here? Fraudster or victim or medium or channel?
Amazon would be the medium through which the fraudsters are selling their defective products.
Correct.
And channel is a marketplace, which we can talk about.
Mm-hmm. And therefore the fraudster and the victims, once again, Jaya, what did you say? Those
fraudsters are the people who are selling the defective goods on the medium, which is Amazon.
Mm-hmm.
And victims are the people who are actually buying these defective products.
Right. Right. Good. Anyone else?
So I was just going to add, maybe the victim here is Amazon also as a business, right? Because they're suffering, their bottom lines will be impacted, and also there's reputational risk from this.
Mm-hmm. Mm-hmm.
That's all I wanted to add.
Okay, good. Yeah, so therefore, guys, yes, here the seller and the buyers, the seller is the fraudster, obviously, intentionally selling the thing. The victim is obviously the person who's buying from these from the seller. And Amazon is the e-commerce platform, and that is your medium and the channel through which this transaction is occurring. And also, yes, Amit, your point is valid. They need to, instead of getting into the victim zone, Amazon needs to be very, very stringent rather, in terms of knowing who is selling their goods and services on the portal. So there is a bit of due diligence that Amazon needs to do to be able to prevent this from occurring. And that is a part of corporate social responsibility that the medium and channel needs to take up right these days. Obviously, for social responsibility and also for personal reasons, which is to not let the reputation and obviously the lost income. So good. Here's another one, guys, and just go through this and tell me who do you think is the fraudster, victim, and medium and channel here. Yeah, anyone?
I'll go ahead, Professor.
Yes. Yeah, go ahead, Jaya.
Yeah, so I think the fraudster here is Madan Lal Jain from the NAC Jewelers. Okay, victim is the bank, basically, because even the company which is receiving the money is also controlled by Madan Lal. They're all they are all together in this scam. So I think the victim is the bank, ICICI Bank here. The medium is also via which the frauds occurred was the ICICI Bank itself, and the channel is an online channel which they are using. They are using the bill discounting method to create these fraud bills and getting the money from the bank.
Good. Yeah. In fact, how close are you to say, Jaya, that ICICI is also the fraudster?
Some of the employees might be involved with Madan Lal Jain in getting these things done, because you cannot pass the documents unless and until, some overlooking of diligence has been not done.
True,
so I
true.
think employees were involved from ICICI Bank in this case as well.
Correct. Good. And I think the bill discounting thing is correct because it's given in the case here on the strength of fake bills. Yeah. So that's true. Anyone else wants to add to it? Anyone? Or should? Okay. So yeah, right, guys. Here, here the fraudster are these two people because they're intentionally doing it, and the victim being the ICICI Bank because they have, they are obviously having these accounts, and the fake bills of entry are the online channels that they use. Now there is a dichotomy here. I would also put ICICI as a fraudster here because I don't think personally, yes, it is true that I put it here, but based on our discussion, there's another view also, and which is that ICICI is also a fraudster because of lack of due diligence, lack of controls, and they are therefore letting these things happen through their accounts or through the banking accounts that they're putting in place. So yes, in this case, the victim is also the fraudster, and that is also a good argument to make for the bank. Yeah. Good. Now, credit loss is therefore the loss that occurs or that results because people are not able to meet their contractual their obligations, and because of that, it impacts the bank, and because it impacts the bank, it impacts the bottom line, and therefore there is a loss that the bank has to therefore deal with. Key goals of risk analytics that the bank needs to be driven by, and that is to minimize credit loss, to maximize, or rather make it most effective, the cost of capital. Cost of capital is how you are using your capital in terms of what is your loan to what is it called, loan to deposits ratio, and if it should be less than 100%, because that means all loans that you're getting, or all deposits that you're getting, you're sending it out as loans. It should not be more than 100, which means you're giving out more and you're receiving less. Okay, so that's your health of the bank. And cost of provisioning is now being governed by regulatory Basel frameworks, which now says you need to make a provision immediately and not at the year end. So initially, provisions used to be made at the year end, and they would eat up the profit, and then they would leave the loss at the end, and that would be used up as provision. Today, you got to make it right today. When you estimated it, when you give out the loan, you got to provision for it if you believe that it's going to be defaulting. Okay, so all these things are driven by risk function in line with, closely in collaboration with the finance head or the finance function. So the key goal is to determine or predict, if this person is going to default on loans or not, and if so, how can you prevent it from occurring again and again? There are some, there is a credit bureau here in the UAE, and what the credit bureau has come out now is something very interesting. As SMEs, when you sell goods and services to a buyer, you're not sure whether this check is going to be honored or not. So you download the app, and once you download the app, what you can see is things like, there is one thing which says as check verification. So when you receive a check from the buyer, you can scan it, and it will run through possible algorithms, and it will tell you what is the probability that this check will be dishonored. Okay, works at 95% accuracy levels. They've tried and tested it for the first 6 months of the year, and now they've launched it. Of course, you've got to be on their site, and you've got to pay a fee for it, but it is a very good system that is going to help detect check dishonorment much in advance, or at the time of you receiving it as well. Okay, and the bureau is also saying of course, it gives you a report based on your credit history. But what if people who don't have a credit history? What if you just started with a credit card? What if you don't have a credit card? Then how do you get to your credit history? They've come up with another formula for doing that. And what they've said is it is dependent on last 4 or 6 months of data based on timely payment of your electricity bills, of your telephone bills, and other commitments that you would have had, your school fees if you're married with children. And those kinds of things are going into the credit bureau to give you a credit history in case you don't have a credit card, which I think is very good because it puts in some checks and balances in place and some systems in place about a person who does not even use a credit card. So it is for everybody in that case. If you're living in a rental property, paying your rental properties. If you're doing an EMI kind of stuff, how diligent are you in paying that? So all these variables go into them determining whether this is what is the risk factor with this person. So let's try and do this as an example of credit loss. Suppose there is a bank that has 100 credit card customers, just for simplicity purposes. And each customer spends about $10,000 a month on the credit card. 95% of the customers use their credit cards and they pay their bills every month. And it's the 5% of customers who are a problem because they do not pay their bills. Now, the bank actually wants the 5% of the customers, because if you don't pay your bill on time, there are finance charges. They also called as they are not revolvers. The 95% who pay are not revolvers, whereas the 5% are revolvers because they do not pay their credit card bills on time. But so that's the 5% of them. Now, if you want to calculate the revenue, what you would do is, what you're going to look at is you're going to look at customers who use your credit cards regularly. Okay, and then in the case, the assumption is all my good customers, that's the 95% of the customers, are using about 50% on an average of their credit limits. So their credit limit is 100, they're only using 50 of that. Okay, so 95 customers on an average are therefore spending $5,000 of their credit cards. The loss, if you want to, or the expense that the bank is incurring is, suppose the bank earns 20% interest rates on bank's rate. They would therefore be earning 95%, 20% interest rates, and 50% of the benefits that they're getting because of 50% usage of the card. And that is at 9.5% is what they get. From the remaining 5%, they're not getting anything because it is a loss. They don't even pay it on time, and therefore they don't get any income from these guys. In fact, it's more of an expense. So now that you're doing the net income calculation, the net income is 9.5% of the income that you make, looking at the loss of 5% of the customers from which you're not making any income. So therefore, the net income is about 4.5% that you make from the entire customer portfolio of 100 customers. The point that we're trying to say here is don't just look at revenues from customers which are healthy, offset that with the expense that you've incurred from unhealthy customers to get you the net income. And this net income shoots significantly downwards when you are, compensating it with the loss-making customers who are adding to the credit loss that you would have estimated. Okay. Just one piece, and then we'll do a quick break before we come back. Now, types of credit risk. There are two broad kinds of credit risks here, guys. Operational credit risk. So we are dissecting the credit risk a little bit more. Operational credit risk and regulatory credit risk. What do we understand by operational credit risk? Operational credit risk operates at individual customer level, whereas regulatory credit risk operates at portfolio level. Okay, at the portfolio of, say, credit cards or loans or whatever that you're looking at. What should you look at first? Operational credit risk or regulatory credit risk as part of your credit risk control systems that you put in place? Should you look at the regulatory part first, or should you look at the operational part first? Yeah, what would you suggest? Anyone? Operational or regulatory credit risk? Operational. Jaya, operational, why? Because operational is at the individual level. That's why. Why?
Yeah, because as per my personal opinion, I think if you can, nip the fraud in the bud itself, then, most of the other things would be much simpler. The other part of it, the regulatory part, comes later on. And I think that comes only when, there are a lot of operational risks in picture. This is what I feel.
Correct. Yes. Bharani, absolutely correct. Regulatory would be mandatory as well. So therefore, are we saying we should not even consider it?
I'm saying like it is mandatory, without which you can't even operate. So ideally, without meeting all the regulatory obligations or requirements, you cannot be functional at all. So I say like both are, yeah.
Yeah, but what should I invest more in at the higher? Forget the regulatory reporting part of it. Yes, which goes without saying that you have to. But as far as, the board committee and the risk charter committees are looking at stuff, should they look at it at the granular level, that is at the customer level, or should they look at the portfolio level? Jazz saying at the individual level, you, I assume, are saying at the regulatory level.
From a management perspective, it should be at a portfolio level, because the guys that at the portfolios or at operations, they will ensure the other aspects of it. So from a management point of view, it should be at a portfolio level.
Okay. Anyone else? In the interest of time, resources, decision-making, actions, banks are looking at regulatory regulatory risks or regulatory operational credit risks, because you will always do the analysis at the portfolio level first. It is always going to be possible. What happened here? I don't know. Just going to. So it is possible that what you're looking at is the customer to whom you've given the loans, but you need to analyze it at the overall level, because it is never going to be zero customer risk that you will get. We know that as long as your portfolio looks healthy, the business is good to go. If your portfolio begins to look unhealthy as an early warning signal, analyze it at the customer level as well. And so therefore, when you do your regulatory credit risk, the analysis has got to be at the customer level. How would you do it at the customer level? You segment, you cross tab, you pivot your analysis to be able to see which demographic groups are causing more problems at the regulatory level. And then in that segment, you got to go and analyze it a little bit more and deeper to find out which groups of customers are causing or adding to this problem. So therefore, definitely the board committee, the regulatory authority, the internal investigations will work at the portfolio level. It is usually called as portfolio analysis versus customer analysis. Those are the terms used, but one is at the regulatory credit risk level and the other one is at the operational credit risk levels. If there are early warning signals that your portfolio is unhealthy, definitely your customer level data is obviously going to be unhealthy. So then you deep dive and analyze and look at that. But if a portfolio seems to be healthy, there's no need to analyze it at the individual level. Yeah. So usually the portfolio analysis is what they carry out. Yes, they went bankrupt for reasons, Kunal, good points. These risk control measures are only getting tighter. And if in the case of a bank, for example, banks were most slack 10 years ago. Look at the fraud that happened, or not fraud, the loopholes that happened 2008. The banking world got disrupted. So there were very, very loose controls that were put in place, say 10, 12 years ago. And now, because the regulator is getting so reinforced and so charged, banks have come into the discipline of putting this forward in a much better way than it was. So yes, this approaches, while we're talking about it for banks, it is applicable for all organizations, in terms of their size, and they need to put in place some kind of automated systems and controls within the organization. So I would say for all the organizations that you would want to, all problems that have happened, for example, the Macy, the biggest giant stores are now discontinuing globally, or you had the liquidation problem with Jet Airways. All these were issues that has led to lapses. And as a result of those lapses, the organizations had to shut down. They were not able to pay their creditors and debtors, and therefore their stakeholders. Good. So guys, let's, if you wish to add anything else, let me know, or else let's take a quick 5-6 minute break and then let's come back and continue with our discussion. Yeah, so let's be a little generous. Let's take an 8-minute break and then come back and continue with our discussion. Sounds good? All right, guys, let's start back. So this is where what we spoke about, operational credit risk and regulatory credit risk. We said that we are wanting to talk about two things here, expected loss and unexpected loss. Now, expected loss is okay, we estimate it, but unexpected loss is a little cause of worry because you had not expected it and it hits you, and then you need to accommodate and account for it. After the Lehman Brothers case in 2008, regulators are ensuring that banks are able to predict the unexpected losses also, especially that occurs because of the environment around you and therefore the market factors, the macro factors that can impact the credit risk. This is an example of a bank that used prudent ways and methods of revenues, and they created a balance sheet which remained healthy. So what they looked at was pre-provision net revenue projections, and they were able to predict their defaults, their customers who would not make their payments, and therefore they had minimum impact on their credit losses. Also, another thing that they did appropriately was to maintain a healthy loan to deposit ratio. As I had said, the loan to deposit ratio needs to be less than 100. A good one is between 90 and 95. If it's at 80 is very bad, which means you're not doing as good as you should be doing. So the deposits that you get and the loans that you disburse needs to be slightly less than 1 or slightly less than 100, so that you have some amounts as reserves in case somebody closes the account in the middle of the period or tenure or a deposit, then you need to pay back the interest up to that period. Okay. So regulatory risk, or at the portfolio level risk, you need to look at three things: expected losses, unexpected losses, and obviously the impact of the environment onto the loss that you can expect to have, and therefore you mitigate or minimize that. So expected losses, obviously, you look at the probability of default, the exposure at default, and the loss given default, and all of these are used to determine the expected loss. The unexpected loss adds another variable to it, and that is the asset correlation. And this is the measure that tells you how your investments that you've made move relative to each other and not in isolation or not in absolute terms. So if you've invested in a particular kind of a customer segment, how does it work with another kind of customer segment? Or if you've invested in a market, how does it offset or work with another market? And that becomes important for you to predict your unexpected losses. Lastly, the macroeconomic factors obviously is dependent on whatever is happening around you. So the formulas are as follows: expected losses, this is standard, probability of loss, exposure at loss, and loss given default. And this case, all other variables are the same, except that you also have the asset correlation, which is an estimation of an unexpected loss based on the relative movement of your investment portfolio. Now, once again, portfolio is what you will always analyze, and you will make sure that your product portfolio, your customer portfolio is always remaining healthy for you to be able to have a minimum impact on the loss. Okay. Now, before we talk a little bit about macroeconomic environment, can we understand from everything that's happening around us, which we cannot ignore when we are putting in our fraud risk frameworks together, as to what are the market dynamics around us that we need to be mindful about when we are looking at a fraud and risk model perspective for 2023? Any specific aspects of the market environment that we need to be really mindful about? Yes. Anyone, guys? Yeah, market environment. Obviously, the geopolitical situation at the global level seems to be a cause of concern, which you need to be mindful about. So countries that you're operating in or countries to which the funds transfers are going need to be watched a little more with due diligence and care now than in the past. So that is one aspect. The recessionary aspects, and therefore, before you allocate loans to your customers, definitely look at their debt to loan ratios. And if it's less than 50% or 40%, go for it. Otherwise, no, because cost of living is on the rise. So that is another factor that you would have to consider. Anything else? Consumer confidence is still okay. It's shivering, it's wavering. And that needs to be also looked at. A lot of people are still postponing their essential purchases, or rather their purchases, and only living with essential or rather supercritical purchases now. So these are some of the elements that the macro environment or the market environment is causing onto your analysis that you will carry out on fraud and risk. Okay. Now, very, very quickly, guys, here's another one. You have three kinds of customers: a highly affluent, a customer with no income, and a middle class customer. So three segments of the customers that you are dealing with. As a result of a macroeconomic impact, a recession, which of these customer segments, affluent, no income, or a middle income customer, would be most likely to be impacted by recession and therefore under the watchdog of the organization in terms of you giving credits or you dealing with this customer group? So affluent customer or a middle class customer, according to you, based on the macroeconomic impact of recession, which is most likely to be impacted by that? I'm going to put you into the breakout rooms for this little exercise. Talk about not just recession, but any other impact that you think needs to be talked about from the market risk perspective. Yeah. So it's a short one. So we'll give you about max 10 minutes to do that, and then we come back and discuss it. Yeah. We'll recreate the rooms. So hopefully you'll have fresh. Okay. All right, people. I think some are still coming back. Yeah. Okay. Yeah. Can we now have some debrief? Guys, when you are allocated to a room, kindly be there because it is only going to add to the discussion. Number one. Number two, your team strength is dropping, which you don't want to do. And it's always good to be there and discuss and share and exchange the knowledge than not be in the room. Yeah, please. Yeah. Okay, guys. Room 1, 2, 3, 4. Anyone? Which segment do you think will be most impacted?
Hello, Professor Dinesh here from room 4.
Mm-hmm.
So we were discussing that, okay, in recession, both the groups will be impacted, but middle class will be impacted more because or the middle income group will be impacted more because they will have some liabilities, because they have income, they have already had some liabilities as well. So they might have to pay for EMIs or, even while buying for groceries, the prices might go up. So it will impact them more. For
Right.
no income group, there might be some subsidies or something that government provides support, like for rations or those things. So they might not be impacted that much, as compared to what middle class will be. And also the number, the second point was the number of middle class income groups is higher as compared to say no income group. So that's why we think middle class will be impacted more.
Okay, good. Any other groups? And upper income, no impact at all?
Upper income, actually, to be very frank, we didn't discuss that point. We discussed only about two income groups. Yeah.
Now that you think of this, what do you feel? Upper income will be or will not be?
Will not be impacted that much, to be very frank.
Okay.
Yeah, it will be just because not for daily needs, but yeah, if there are long term, there are some not long term, short term liabilities that they have taken for high values, then only they might be impacted. Yeah.
All right. Okay. Any
Professor,
others?
yes,
Yeah.
Professor Barney here. Like myself, Moni Raju, and Nisha, we discussed.
Okay.
Like basically, what we feel is like, all the three segments would be impacted depending on the scenario. To be frank, for instance, like when there is an economic crisis or a recession, I think the middle class people or salaried people will be affected pretty badly because they will lose their job, their salary hike will not be there, salary cuts will happen. With the commitments what Dinesh shared, I agree that is the worst affected. And when there is a pandemic sort of thing where right now what we are seeing right now, what we have seen right now, recently, like the people below poverty line are the worst affected, like, or the small wages, small shops guys, the people with low salary, they are the worst affected. And if there are some sort of regulations or some mandatory impositions from the government in terms of the rules and regulations, like demonetization, for instance, people with high salary or the business people, or they are the worst affected. This is just what we discussed, and there is no one fit to criteria as such who will not be affected. It depends on the scenarios, right?
Okay. So you are saying, Bharani, that all three segments?
Yes, all three based on the actual crisis. But one example we quoted, but there are multiple scenarios which will affect different people upstairs.
The inflation in the US, which is skyrocketed to these numbers, has been attributed to the fact that the stimulus packages were given to everybody last year, irrespective of whether they were unemployed, underemployed, or overemployed. And they were all given a stimulus package last year, as a result of which the US is going through its own problems right now. So, yeah, okay. Any others? And a low income person, a no income person continues to be risky to the bank. Why? Because they have no income and therefore they're not eligible for anything. Okay. So, or if you suddenly have no income because of a job loss or for whatever reason, then that customer group becomes, becomes a risky segment immediately when you have no income. Therefore, a lot of banks have now introduced a product saying a job loss insurance. So if you lose a job for whatever extraneous reasons, you do get a certain amount up to 6 months till you find another job. So they continue to be risky to the bank. Suddenly, if you have income and you have no income, or if you have no income, you continue to be having no income, that segment is not going to be touched by the bank. All three segments agreed. So therefore, this is the low. The middle class income is also shrunk, and therefore the consumer confidence part comes largely from the middle class segment. That is the largest segment. And they are going to therefore have the largest impact onto the balance sheets of the banks as well. The upper income will be the least impacted because they do have offset their income into other areas that can at least survival happen. Basic EMIs happen unless your expenses are skyrocketing to incomes. Some people that I know during the pandemic, they belong to the super income strata of the society. And interestingly, they were on EMIs and they were not able to pay their EMIs on their loans, on their house loans and other loans. Interestingly, they had top-end cars and they were not able to get parts of the top-end cars to be able to fix those cars, and the cars were just lying in their garages for about 2 years because that part was so expensive and they couldn't afford one. So we think upper income, but depending on the lifestyle extravaganza, it is very important to know that is this upper income actually income earned or income to be paid for in the form of EMI. So yes, so all three segments in their own case, but everybody therefore gets impacted because of an external market environment. And therefore, if you've done strategy together, guys, I heard somebody say that in the group, and that's very, very essential. And that is the pestle analysis that you did, the macro environment analysis that we talked about there, has got to be now used at least once a year in your fraud and risk analysis as well. It does have a direct correlation to your policies and procedures. Yeah, good. So, earlier we couldn't measure the impact, and therefore a lot of problems happened, like the 2008 crisis. But now we are in a far better position, and we do have pestle to look at it, and we do plan for, uncertainties. And those plans, thanks to the pandemic, we've been able to handle them much better than we would have done otherwise. So survival analysis is one time of analysis that we do, and that is, what is the bare minimum that you would be doing or paying for if all other things go off? So, you're on your Maslow's hierarchy of needs, food, clothing, and shelter are the bare minimum that you examine here. And are you able to meet that requirement or not is what is done at the portfolio level if the portfolio is found to be unhealthy. Dual time dynamics is something that is the loss that you would expect it to happen. For example, if there is recession now, you would have an impact now, but it is expected to get better by the end of the year. And so therefore, the average is what you will look at during the year to be able to determine the loss that can happen because of the environment. And obviously the impact of the macroeconomic environment as well, called as long odds and social score curves. Those are used based on years of experience, like people said, the earlier recession that had happened and the learnings that you get from there, and that is what you will deploy in the coming recession that is expected or anticipated to happen next year. So there are micro or macro or environment analysis, which used to not have an impact on the fraud and risk, has begun to have a significant impact on putting together policies and procedures of fraud and risk. So therefore, in the risk department, you've got one person or two people dedicated to looking at macroeconomic risks. So they take large inputs from strategy, and the key input that they take from strategy is the pestle analysis, which is then analyzed for them to be able to come up with impact of macroeconomic variables onto their fraud model that they're determining, portfolio analysis that they're carrying out. And if the portfolio seems to be unhealthy, then they will drill it down to the customer level also. An interesting video of what McKinsey thinks about risk and advanced analytics, and I'll share that with you in a minute. I'll just switch it on. Share. Yeah, here it is. And what is their perspective?
It's estimated that the world produces 2.5 exabytes of data every day. In the past 2 years, we've created more information than in the rest of human history. Businesses are rushing to use advanced analytics to more accurately assess and price their risks, mitigate unwanted risk exposures, and tailor their strategies to achieve extraordinary risk-adjusted performance. In this area, McKinsey brings our clients a distinctive value proposition. We combine our expertise in risk analytics with deep experience and understanding of the business context at hand. The results provide significant and lasting impact in business performance. For example, stress testing is an area we've had great impact. In the United States, we've helped numerous banks' forecasting approaches through the development of revenue, expense, and loss forecasting models. We're now extending this expertise to new markets where banks are facing increasing regulatory pressures to conduct more extensive stress testing. Stress testing analytics also supports the strategy behind large capital-intensive projects. We've worked with several mining and energy clients whose projects are capital-intensive and especially sensitive to commodity prices. We've built models for banks, insurance companies, and others to predict credit risks, improve loan monitoring, fraud detection, and collections. In an Asian bank, our efforts led to a 30% lower loan origination cost and a 50% reduction in both turnaround time and overall losses. McKinsey is also at the forefront of model validation and model risk management. Our recent acquisition of Risk Dynamics, a leading risk analytics firm, further bolsters our abilities in this burgeoning area. Banks, insurers, and asset management companies have long relied on statistical techniques to rate borrowers. Today, we can complement traditional analytics with new techniques, such as machine learning, to find previously unidentified patterns to help clients make more accurate predictions. At a European car insurer, 40% of all fraudulent drivers were clustered within the 20% of drivers that our algorithms classified as high risk. We've helped a Latin American telecommunications provider enhance their collections process and identify the 15% of customers causing 83% of losses. Models built purely on statistical knowledge can result in a wonderful correlation that's just plain wrong. Numerous models cluster customers into risk segments based purely on statistics. The question is, how should the business approach these different segments? Our business knowledge allows us to build meaning into these segments, providing new insights into how to manage the risks of these segments more effectively. We believe that risk-advanced analytics are the next frontier in risk management, using the data revolution to better predict, monitor, and mitigate risks. Because after all, it's not the data, it's what you do with it.
Something, guys, McKinsey was not at all, 5 years ago, if you would talk to McKinsey, they would not even take up the assignment on risk analytics, and you had specialized firms doing it. They've also talked about it with their acquisitions that they've done, and they have extended their arms into risk analytics using machine learning and advanced analytics and statistical analytics, as they've said. This is an area which is increasingly getting popular, and therefore a strategy-related firm like McKinsey has also gotten into fraud and risk analytics here. The others have also, but they were the first ones to take that extension. And so when they themselves, if there's another interview by their principal, which said, I myself was surprised when clients told us that, yes, let's do risk analytics with you because we were not a risk analytics firm. Okay, so interestingly, is that what it is? And that what it directly resonates to what we've been talking about so far. Having said that, let's move on. So here's another quick one, last one for our day today. And here, please take a picture of this, guys. This is the case of Wells Fargo commercial loan portfolio. So this is at the portfolio level again, and not at the customer level. And they had some bad projecting that they did in Q1 2020 or whatever that year was. That has led them to some problems. And we will just quickly discuss this in terms of, this is the case, and based on this case, what kind of operational risks or market risks or fraud risks are evident here. That's one part of it. And what are the problems that are getting highlighted in this part of the story for Wells Fargo commercial bank? Yeah. In the last one, we did not discuss market risks. We talked about it separately. And now in this one, I believe market risks are also playing a significant role in terms of fraud and risk analytics. Yeah. So keep that in mind when you discuss it as well. So we'll give you a quick 10 minutes to do that, and we come back and discuss this then. Yeah. Sounds good? I think we'll keep 3 rooms now because some of our friends have already gone for their Sunday siesta. So it's okay. Let's move on for us who's going to continue. All right. So let's give you 10 minutes and then let's come back and discuss this. Yeah. All right, people, let's go for it. There were 3 rooms, but I think the third room was not joined. So therefore, we have 2 rooms only. Guys, once again, if you're in the class, kindly participate. This is not an escape route where you just log in and leave. As we saw from 19, we've come down to 10. So kindly be in the discussion rooms. It only helps your fellows and colleagues to get your views. Otherwise, their numbers go down. So guys, before we go for our thoughts of discussion, there is, I just see the chat, there is a feedback form there. So kindly fill one and then we can discuss this and wrap up our session for today. So just take a couple of minutes and fill this if you haven't done it already. If you're done, just let me know so that we can move on. Done, guys? Great. Good. Thank you so much for doing that. Let's move on. I think about half have done it, so the others are still doing it. Kindly do. And let's move on with our discussion. So who, room 1 or room 2? Who of you would like to go first? So what were the observations from the Wells Fargo bank that we just saw? I'll just put it up one more time so that we can discuss it. Here it is. This is what we were talking about. Okay. Anybody? Room 1 or room 2?
Professor, we'll go first. We were from the room 1.
Please go, Jaya.
Yeah. So, Professor, what we felt was that the Wells Fargo Institute, they should have, done a sort of a pestle analysis for their commercial loan portfolio, at least, to understand that, what are the conditions which are prevailing in the market, so as to, shield themselves from the existing risks. So they did a lot of, they have given out a lot of commercial loans which have gone bad because of the pandemic.
Right.
But if there was a regular screening of the loans which were given, there was a regular analysis which was done at the back with the pandemic condition also, then they could have offset some of the losses. Like, for example, if the pandemic had started and say somebody from the analysis team might have said that, people might not visit a mall now. So they would have revisited their accounts where, they were giving out loans to the retail segment.
Right.
Or similarly for the oil industry also, if everybody is at home, then, the usage of oil, both in commercial as well as in the retail space, would have been less. So they should have, decided that they would not be giving out loans, or they would have reduced giving out loans to the oil industry.
Correct.
So that's where the exposure should have been reduced, and the projections should have been modified so as to take into account the current prevailing environment. Like a pestle analysis should have been done thoroughly.
Okay, good.
This is what we discussed in our room.
Okay, very good. So yeah, I like the use of the word pestle. So correct, I agree. What about the other room?
I think we discussed similar points, Professor,
Sure.
on the similar lines. So the macroeconomic factors should have been taken into consideration. And also already the portfolio was stressed because of the pandemic. And they had a lot of reserves to offset that losses, predicted losses. And they should have been careful. And also because of the inflation and recession that is coming in, they should have taken into consideration those factors before giving those projections of mid-teen percentages.
Correct. Absolutely.
And also to add to that, for same group, Dinesh, we also looked at that number, 6 some billion. That is very huge amount, in terms of just reserve for one quarter. So that's what we thought that, okay, whatever, predictions were there that it will go down by some, 10%. But the reserves which were made for those loans were very high. I think that's what we also discussed.
Correct. Yeah. So therefore, guys, this case throws a lot of attention on expected, unexpected losses and market risks. And I think all of this comes here because it is all because of bad provisioning in Q1. That's the headline, which means their estimate of loss and unexpected losses seems to go wonkers for the bank here. Also, rightly said, pestle analysis needs to be done, not just one time, but regularly. Just because they did it in the end of the year does not mean they cannot do it in Q1, does not mean they do it in Q2. Now, when they said bad projections in Q1, which means now that time has elapsed and you're looking at it in Q2 or later than that, which means it would have only manifested, it would have only added to the losses, and that would have eaten up the bank's credibility in terms of both reputation and the loss that the bank has made. So yes, rightly discussed and summarized from that point of view. So these is just putting the points down that we discussed. So it had to take such a big provision in the second quarter because they did not do their jobs right in the first quarter, because their estimate of loss, expected and unexpected, seems to not be appropriate in line with market trends. Their asset correlation was high, which means across the border, their investments did not fall appropriately. So let's just look at this. The bank boosted up its reserves. And as I think Dinesh mentioned it, 6.4 billion, a very huge number there. The consumer losses were facing pressure because of the pandemic. Not only reduces foot traffic at businesses and places, but also changes demand for some buildings. So there is no need for an office space. There is no need for commercial spaces. Okay. And therefore, their investments in oil and gas and real estate seems to not be doing well. And therefore, the asset correlation did not do very well for them. What their CEO said, and this is an excerpt from their interview, that the company's earnings call that our view of the length and severity of the economic downturn has deteriorated significantly or considerably from the assumptions that were made last quarter, which drove 8.4 billion addition to our credit loss reserve in the second quarter. So 6.4 plus 8.4, all because of poor estimation of losses and not taking and not able to understand or decipher the learnings that you're getting from the market environment. So this case, of all the risks that it possesses, I think market risk is right on top here, which we now know can have a significant impact onto losses. And you definitely need to be, constantly reviewing your market risks because we live in an environment which is so dynamic, especially from the point of view of the market that we are in. Yeah. Yes, Dinesh, I see the hand raise. Is there a question or?
I just want to ask something. Again,
Sure.
This might be completely different to what I'm thinking. So
no
instead
worries.
of just, thinking of making reserves or for bad debts, they would have opted for some different strategy to reduce that losses instead of making higher provisions.
Correct. Good point, Dinesh. And what would that strategy be? Let me stretch that a bit for us.
Yeah. So maybe, say, for example, instead of thinking that, okay, I'll not recover anything, maybe we can provide some discounts to those.
Based on what? Based on what?
Okay, based on their past performance, how they have been prepaying us the loans.
And therefore, now you're a fraud and risk specialist. So therefore, the word that you will use is market risks.
Market risks. Right.
Yeah, because in Q2, they could have avoided that 8.4 because of the bad learnings in Q1.
Right.
But they seem to ignore that.
Yes.
Yeah, and by the time it was 2020 Q2, we had a fairly good understanding of the virus around us.
Yep.
Yeah, so learnings from Q1 were not taken on board into Q2. And by the time they decided it was too late, half the year had passed by.
Okay.
Yeah, and that's where, guys, words like agility, words like prudence, words like data-driven decision-making, and data-driven fraud and risk analytics have become very, very popular in organizations that we see. Good, Dinesh, good point raised. Yeah. So you agree to what I say?
Yep. Thank you. All
right. Wonderful. Any other questions, people? And I think that's pretty much what we want to talk about. And why this case is given, because, up until a couple of years ago, we were not looking at market risk. Market risk, there was no, understanding and no consideration or no classification of that into risks. And now, because of market risks, poor estimation only see the impact that it can have on a loss that you can definitely avoid or definitely minimize, if not avoid. Okay, so like operation, like credit, like fraud, market risk is also very, very important for you to be aware of. And next year, if you don't take measures right now, the Q1 recession is going to have a bigger hit or impact onto the way things are going to look at next year. Plus, the geopolitical situation around us is creating more problems that we need to be aware of. The Russia war, the Sri Lanka crisis, the China and the Southeast Asia crisis there, the European crisis in its own different forms, the US crisis, and amongst all these crises, it's going to be very important to see how economies are going to build up into what things are going to look like. When the aviation sector is just opened up, there are caps being placed by the busiest airports in Europe in terms of what flights they can handle. And as a result of which is putting pressures onto people to, push this sector forward much more. They were going to reach pre-pandemic levels, but now that is a wait and watch approach. So good. Any other questions or points, people?
Professor, just a question on the project, nothing to do with the project.
Sure.
Like any suggestions, like do we need to go ahead with Python or Excel is still okay?
No Python, my friend. Unless you want to do it, it's okay, but it's not a requirement. And it's pure Excel is good enough for us. Okay, because the assignment is designed with Excel in mind.
Okay, Professor. Anyway, that suits me, I think.
Yeah, I was about to say if you will do it in Python, tell us about it also.
No, there are much more better people than.
Yeah, so for me, everybody who can do it is much better because I can only do it in Excel.
For me too. Thank you, Professor.
All right, awesome, good. Any other pointers, guys? So your feedback, once again, guys, I'm not able to see it, but I assume it's going good. Any comments that we're doing, I hope you're on the right path because we still have one more class just in case we need to add or subtract any elements from our pointers. I hope we are. and your validation will help. So we are, I hope, right?
Yep.
Great, wonderful. So breakout rooms are useful.
Breakout rooms are very useful, to be very frank.
Very useful.
Very useful because many new faces for the first time, Professor.
Many new faces for the first time. Good. So, and you know, the kind of discussion and engagement that happens personally, that is far more valuable and adds to the knowledge than just a one-way or a two-way discussion. It's a multi-way discussion. I think that really adds value to the richness of the class. So thank you very much for contributing and taking it to that level. Okay. So good guys, enjoy the rest of the day, enjoy the week ahead of you, and we'll see you at the other side of the week, which is on Saturday, which is our last class. And we should be able to wrap it up. And we'll also, as I promised, we'll talk about the final exam at that point of time. So thank you very much and see you Saturday.
And Professor, we'll have a session this Tuesday for the project briefing, or you said there will be a class, no?
No, there is no discussion on that. We can talk about it on. Do you want a session? Because I think it's very.
No, I thought like I was under the impression that you said like there will be a session post this LS3 for the project.
No, there is no session. No, there is no separate session for that, and I don't think you will need it also unless you want it. Let me know.
No,
but I don't. Yeah, I think it's a pretty straightforward assignment this time compared to last time. Last time actually. There was a problem because the wrong assignment had gotten posted and I was discussing something else. But this time we made sure that what is there is right. And it's pretty straightforward to looking at your mindsets. I think you guys should all be able to do well. The focus is on interpretation, guys, and please focus on that.
Yeah, Professor. Thank you.
Yeah, good.
Yeah.
Awesome. Take care. Bye, guys.